As we've spoken with people approaching retirement, there's three major concerns that keep coming up: the stock market, the future of Social Security, and paying for health insurance. Today, Vince and I are going to tackle the first of these three, the stock market, right after this. Hey, welcome back to Wealth Wednesday, our bi-monthly show, or at least it's supposed to be. The flu bug has got us here in the last month or so. We're here to help you make sound financial decisions. You can find past episodes on our YouTube channel. That's at Commonwealth Financial. You can learn more about our firm at cfswb.com. If you happen to like this video, hit that thumbs up button and be sure to subscribe so you don't miss an episode in the future. Welcome back. I'm Neil Watson, the CFP Pro in Marietta, Ohio. I'm joined today by Vince McManus, the CFP Pro in our Parkersburg office. Vince, as I've been talking to people here in the first quarter, especially those nearing retirement, they have three big concerns. The first one, the stock market, obviously. So we've seen some real fun here lately. The future of Social Security is a big one as well. And then how to pay for health insurance comes up on the list oftentimes as well. We're going to talk about the stock market today. So just kind of giving a backdrop of what we've been dealing with. We've just had 2 consecutive years of 20% gains in the major indexes. It's the first time that we've seen that since 1998 and 1999. Now, one of the things that we use to measure whether the stock market is expensive or cheap is the price earnings ratio. And right now it's about 21.5 times. And historically speaking, this is real close to red alert levels. Not quite there yet, but very, very close. And there's a lot of outside noise influencing the markets, from tariffs, federal layoffs, the daily headlines. So Vince, is there reason for concern?
Depends on your time frame, is what I always come back to. But I remind people that volatility is a feature, not a bug, of investing in public equity markets. So market swings are a natural part of investing. You couldn't have the good without the bad. That's just a fact of life. We always think of the concept of no pain, no gain. That's true in investing also. The good part about it is if we can handle our emotions, the pain is actually not really pain. It's just forcing yourself not to make a very bad decision that shouldn't be painful if you're managing your time frame right. And that's really what the big thing is in investing in equity markets. So again, market downturns, they are inevitable. They're going to happen. It's a matter of when, not if. If I had a crystal ball, you know what? I probably wouldn't be here. After downturns, I probably can explain most of what happened with complete clarity, but that's not how life works on the front end. They're going to be uncomfortable. Doesn't make me happy, but they are temporary. A good person that I read a lot named Nick Murray always points out that the stock market has never failed to achieve an all-time high. So we can break this down and say, what causes some of the market swings? Well, right now, like the big thing, obviously, is tariffs. Again, if you talk to most economists, and by most, I mean any, typically they're going to start off with, hey, tariffs are bad. Again, does that mean like they never can make sense and that they aren't actually happening in the real world? Yes, but you would expect, if you think the market is somewhat rational and you're a believer in private enterprise, that if you start having trade wars, that is going to affect the market negatively in the short term. If it didn't, I'd actually probably long term be a little bit more worried, because that wouldn't make any sense, right? So tariffs relate into the economy. Again, there could be some slowdowns in hiring. We are trying to cut some federal staff, which we notice a lot here locally with a lot of the federal employees that are here. Like that probably tends to sort of hurt some of the economic numbers, especially if you enter into a downturn caused from tariffs from private enterprise. Well, if you're hitting it on the government side too, that could exacerbate it over the short term. So I think we're maybe seeing some of that. And part of the reason that we may be seeing some of that is the third prong here, which would be interest rates. Interest rates still maybe a little bit high. Inflation still running a little bit hot compared to what the Federal Reserve's official target is. So I think the administration's thinking maybe that, hey, if the economy is overheating, they'd like to see interest rates come down. Whether that happens or not, I don't know. Neither does anyone else. And that's kind of what the issue is. There's a lot of unpredictable factors when you're thinking about trying to manage a country of 350 million and in a world of 7 billion that has at least always been interconnected in some way through some sources of trade, right? So you're always going to have unpredictability. There's always going to be these things happening, and you just can't predict what's going to happen next and when it's going to happen and what is going to be the catalyst, because again, markets are a function of people and human nature. So again, the herd mentality is always going to be there because that is how we're wired, and that's what happens, and you don't usually know what's going to cause it, and then once it happens, boom, there you are, and you're in a correction.
Yeah, and it's wild how people react all of a sudden to this. So back in January, investment data firm Morningstar released a summary of the capital market assumptions from the big investment houses like Vanguard, JP Morgan, BlackRock, Fidelity, and Schwab. The big takeaway is that most of these firms are now expecting stock market returns over the next decade to be lower than their historical average. It's anywhere from 3% to 7% per year, so low to mid single digits. They're estimating bond returns to be between 4 and 5% per year. So I went back and looked at some data. We've had 10 times since World War II where stock markets have had decades of 3 to 7% returns. And during those times, there's been a lot of volatility. On average, over those decades, there have been 3 negative years during those timeframes. And the average decline during those years is about 15%. The positive years return plus 17%. So if we're expecting single digits, it's not going to be 4%, 5%, 6% on the nose each year. It's going to be a lot of big ups and some pretty ugly downs. There was one bad year that had, or one 10-year period that had only one bad year, and that was the 2008 timeframe when we had a minus 37% year. So that's a pretty extreme example, but typically when we have these slow decades, it's a number of negative years with some pretty significant decreases. So volatilities could be very, very interesting as we go forward. Vince, how are we going to prepare for a volatile decade if that's our expectation?
Again, one, I would start off with, and I point out, and you never know, and speaking of how hard it is, backtrack a little bit to forecast this stuff. I've looked at a lot of these, what do they call it? Capital market assumptions for the last 10 years. And I worked at JP Morgan before I was at Commonwealth. So I had a nice meeting every single year to go over their capital market assumptions. And I would say that if I go back the last 5 years, they've been projecting the 10 years to be between 3 and 7. So even they don't know, and they spend more money than anyone else in the world. And it's just very hard to predict. But what we like to do is we deal with things from a planning perspective, because that makes the ride a little bit smoother and makes the expectation smoother, so we don't get into things that we can't control. But one, you have to manage your retirement cash flow. If you think of your family as a business, cash flow is always king. It's very simple. If you spend more than you earn, you're going to increase the risk of running out of money, right? And Neil pointing out that the volatility and having a 4 to 6% decade tends to usually happen in times when it is more volatile. Well, that's where your portfolio withdrawal rate matters more than it does any other time, because that volatility is what can really change the amount that you can pay yourself the rest of your life for your paycheck in those bad years if you're taking too much, right? So flexibility is also key. I like to think of it this way. If the market does have a bad year, consider cutting back on discretionary expenses. I always tell people your timing, like, hey, give me some bucket list trips or bucket list things that you want to take. And what we want to do is say, we don't want to be so set off or it needs to happen this year or next year or the following year. Say, we have a window of when we think we can do this, and we try to help kind of nudge into, and like, hey, the market's been great for the last 2 years. I've had a lot of people the last few years, I've say, let's spend a little more this year. You're higher, you're outpacing your projections. We don't expect that to happen forever, but hey, let's take that extra distribution. Let's do that trip you've been wanting to do, because I know that at some point you're going to have some bad years that I'm going to have to have the difficult conversations. Say, hey, let's try to cut back a little bit this year to get through this downturn. The other thing that we like to do is reduce exposure to quote unquote risky assets, which what I mean by risky asset essentially is equities. I'm talking just about volatility, right? So if you have, a plan that's saying, hey, if we assume this rate of return and we're all the way good, and I look at your asset allocation and we're saying, hey, this asset allocation, we'd assume this rate, there's a spread there. If you're really going to be bothered by some of that downturn, then hey, we need to invest less aggressively, and you can afford to do that. So we sometimes like to do that as well. And the times that you do that, again, is when the market's doing well, right? You don't have that conversation when the market's down 20, 25%. That's when, I use the analogy of you're in the airplane and there's turbulence. You don't just jump out the window. You hold on to the guard to your seat. And that's what you do there. And then the next year when it's probably better, and then someone's telling me like, well, yeah, now my account's back up, I kind of like where I am. I'm going to remind them of what happened last year, right? So that's what we like to do. And again, to me, like volatility is normal. That's the price of entry of being an equity market investor. Okay. If it were easy, everyone would do it. And good investing can be simple, but it can absolutely never be easy. And that's why we focus so much on sticking to a plan that aligns first, most importantly, in my opinion, with your goals and what you want. And then secondly, with risk tolerance.
So preparing for market uncertainty is about having a solid plan and being mentally ready for the ups and downs. Again, volatility is a feature, not a bug of the equity markets. The next decade could be more volatile. That doesn't mean you can't navigate it successfully. Thanks for watching Wealth Wednesday. Don't forget to subscribe. Hit that thumbs up if you enjoyed this. And if you have questions, visit our website, cfswd.com. Thanks to Vince for joining me today. Have a great week, everybody.